Now let's change the perspective of the problem a little bit. In the last example, I showed you what if the borrower has a lower interest rate, right? If the borrower saves 25 or 50 basis points, what happens for their NPV, right? They're saving money, they're getting the value, and so they see a positive NPV. But from the lender's perspective, if I'm giving you a better rate than I should be, they're going to be the one losing money. So let's flip the perspective a little bit, and now let's look at the NPV from the point of view of the lender. So from the lender's perspective, we just have to recalculate our NPV here, right? What are they going to get? The present value of payments. What are they going to pay out? That $200,000 of the initial principal balance. All right, so here we still have our discount rate equal to our interest rate, and so the NPV is 0, right? Interest rate equals discount rate. We're going to always have an NPV of 0. So now let's actually think about, well, what should the discount rate be for a lender, right? Lenders, big banks, have access to capital much more cheaply than us individual consumers, right? They're able to borrow more at corporate borrowing rates. So if we go out and look at rates, they're going to be less than interest rates for mortgages. So let's just say 3% is their cost of capital, right? So if 3% is what they can borrow at, now their discount rate is 3%, whereas the interest rate is 4%. So on this $200,000 loan, what's this loan worth to them? Well, $18,000, right, in present value terms. So this is how banks essentially make money, right? They borrow at 3%, lend at 4%, and make that 1% difference over a long run of time. All right, so the simple view here is that we have this 20-year loan. We can just go ahead and discount all 20 years of cash flows back, and that's where we get our $18,000 number. But in reality, banks know that people don't hold that loan for 20 years, right? You're going to have what are called prepayments. So some borrowers are going to prepay their loan early. Sometimes they'll prepay their loan early because mortgage rates fall, right? If rates fall, you can then refinance into a lower cost mortgage, so you pay off your old mortgage and take out a new mortgage. Alternatively, you could sell your house, right? If you want to upgrade to a bigger house or move to a different city, you'll sell your house, and at the same time, you're going to prepay that mortgage. It turns out on the average 30-year mortgage, on average, those loans tend to pay off in around 7 or 8 years are the last numbers that I saw. So prepayments are a very real thing that lenders need to worry about. And if a lender's thinking about this, they can't count on this $18,000 NPV. They need to account for the fact that these loans are going to pay off early. So that's what we're going to do now, is we're going to build in this prepayment idea. All right, so what I've set up over here on the right-hand side is we're going to think about prepayments occurring at month 12, 24, 36, or 48. So there's going to be a 25% chance of each. Again, these are very fast prepays, so it's a little extreme, but it'll give you an idea of how we would build this model out. So what are the cash flows to a loan that prepays in 12 months? Well, the present value, right, we'll do this in present value terms. Well, it's going to be these first 12 cash flows, right? We're going to do this kind of sloppily first. And then plus, in this 12th month, you're also going to get the return of all that principal, right? The return of the principal, though, we also have to multiply by the discount factor, right? Because we want to get the present value term. And so we would see this series of loan amounts. The present value of that, well, we can just sum up this entire column. Let's actually go all the way to the bottom. And actually, I don't want to go all the way to the bottom. Let's go ahead and actually copy this down. I'm going to my very bottom cell and just putting an X down here. So let's just go ahead. Now I can sum, not all the way to my X, but right before. All right, so the present value is $201,000. If we actually calculate the NPV, let's subtract off our principal balance at the beginning, and let's change that to NPV. So that loan would be worth $1,938. All right. Now you could do that exact same thing where I just kind of copied down for these 12 cells and manually figured out what are those present values going to be. But you'd have to do that for 3 more prepayment periods. And really, in reality, you'd probably do this over maybe 30 different years of prepayments, or even every month. So now we're talking about 240 different months to do this over. All right. You don't want to have to do it that way. So let's figure out a way to do this with a formula. So what we're going to do here is we're going to say if, and now let's say if our month is less than or equal to 12, our parameter, then let's include our payment amount, otherwise 0. All right, so that's going to be just our payment amount. If we drag this down now, let's copy that down and make sure it works. It looks like it worked at least for that piece, right? But now we have to also layer on our second if statement here. It's going to be nice to just separate the two components out. It's going to be if the month is now exactly equal to our prepayment month, well, then we get another cash flow. And that other cash flow is going to be the ending principal. Again, we want it in present value terms, so times the discount factor. Otherwise, add on 0. So let's check that out. If we drag that down, oh, it didn't show up, so let's troubleshoot it. All right, we see that I wasn't careful and I didn't lock my cells. So let's come back up here. And now as we lock our cells, let's actually think a little bit more, right? We know we want to lock that L3. All right, so let's make sure we lock L3. All right, I locked it before in the first part, but not the second part. But I want to think through this L3 lock a little bit more because I want to be able to set these cells up to drag over to the right. And if they're going to drag over, I want that L to turn to an M, to turn to an N, and turn to an O. And so if I toggle again, F4 one more time, I take the lock off the L. All right, here all I'm really interested in is locking column row 3 so it doesn't move down as I drag down. So let's actually come over here to our other L3 and lock that. While we're here, let's think about E7, right? As I drag this thing to the right, I don't want column E to move. So if I toggle through my F4 options, I get the lock on E, right? I want to lock the month there. Here with K7, I want to lock, again, the K. E is going to be another column lock. And then I and J, same thing. We got to lock those columns. That way when we drag this over, it's not going to move on us. So once we've set up all of our lock values, we copy it down, we see we got that to work. And if we've set it up properly, now we can just drag it over our 3 extra columns. And now we see that we got that same thing working throughout, right? It's going to 24 months, 36 months, and now to 48 months, all right? So it's working for us throughout that option. Now let's actually go through and check our NPV out. Did we mess something up here? Let's scroll down. Maybe to our bottom, maybe we messed something up a little bit at the bottom. Ooh, we have a value error at the very bottom. All right, so let's go check this out. Well, we didn't have any cells there. Let's see, is there anything over there? No, there are no cells over there, so I just copied down too far. Let's take that out. Now our NPV works. If we drag that across, we can see our NPV for those 4 different types of loans, one that prepays in 1, 2, 3, or 4 years. And if we want to get now the expected value of this loan, now we can just use our sum product to multiply the NPVs times the probabilities of each of those NPVs. Here I was assuming a 25% probability that each loan pays off either in 1, 2, 3, or 4 years. Again, that's a super simple estimation. It's not at all accurate in reality, but it gives us a way to build our model out. All right, and now we can say this loan is worth $4,500. So what's the true value? Well, it's not the $18,000 way down here. And it's also not the 4,500 up here. We'd need a lot better data to decide. It's probably somewhere in the middle of those two. And again, this is all dependent on our model parameters, right? We put in a 3% discount rate and a 4% interest rate. As those things change, the model output is all going to change. But how we design and build the model, that's a more fundamental thing that we can really focus on building our efficient models to value loans.